Welcome back guys, my name is Angelo. Now that the stock market is getting closer to its all-time high again, you're probably wondering if investing into your favorite ETF or company is a good idea right now, or if you should hold on to your cash and wait for lower prices before buying. I don't blame you for feeling that way. After all, everyone prefers buying things on discount whenever possible. Since I get so many questions on this exact topic, let's take a closer look today and try to answer these two questions. First, why does the market go up in the first place? And second, is it better to wait or to invest right away even when the market is at an all-time high? You might be surprised by the results based on historical data. As usual, I'll try to include my own experiences I've made over the past 6.5 years of investing into the stock market via low-cost passive ETFs. After all, these represent the main pillar of my long-term investment and early retirement strategy. We'll even take a look at all the instances where my wife and I bought shares at record highs and what happened since. I was really excited to do more research into this subject as well, so it's definitely going to be interesting. Alright, first of all, it might be useful to understand why the global stock market goes up over the long run. Reason number one is economic growth, which leads to business expansion and more innovation. This usually leads to higher earnings and companies becoming more profitable. Since the most profitable publicly listed companies operate globally, they're not limited to their home market, but also benefit from higher rates of growth in other regions, including emerging markets, where people start consuming more as living standards improve over time. For example, here's the current rate of GDP growth in Europe and the US during the ongoing recession, and here is the rate of growth in major emerging economies in Asia, Central America, Africa and the Middle East, resulting in the world as a whole growing more than twice as fast as developed markets on their own. Progress in technology also leads to increased productivity and efficiency, which enables companies to expand and become more profitable as well. We're actually seeing this happen right in front of our eyes as we speak, with AI becoming more and more useful. And lastly, inflation increases the price of goods and services over time, which tends to lead to higher revenue for companies, which is then reflected in their stock price. Stocks have long been an excellent inflation hedge. One recent example we can look at is Argentina, which has been facing extremely high inflation rates from 20 to 114% per year over the past 10 years. As a result, the local currency, the Argentine peso, lost 98% in value over the past 10 years alone. Now let's take a look at their local stock market. A share of the S&P Merval index, which is made up of the largest stocks in Argentina, stood at 3,358 pesos in July 2013. For reference, that would have been 459 euros based on the exchange rate back then. Now, if someone kept that amount in cash instead of investing it, it would only be worth 10 euros and 68 cents today. Meanwhile, those initial 3,358 pesos grew to 461,280 pesos within 10 years in the Argentine stock market. But was that enough to counteract the currency losing 98% in value against the euro over that period? As it turns out, yes. The initial 459 euros turned into 1,467 euros just 10 years later, for a yearly return of 12.36% and a total return of 219.5% in euros. Now, it's not like extreme levels of inflation like that are good for businesses or the economy, but at least we have plenty of examples in history showing that investing in stocks, even within a country that's affected by severe inflation, is usually a very effective way to protect your buying power long term. Turkey's stock market is another example. It 10x'd in its local currency over the past 10 years, while the Turkish lira lost 91% of its value against the euro. While in this case investors didn't achieve positive returns converted to euros, they still only lost 7% of their wealth compared to losing 91% if they had kept their money in cash. This is actually one reason why I believe everyone should have at least some of their investments invested in hard assets like stocks or real estate, as these have shown time and time again to be an excellent way to protect against inflation or even periods of hyperinflation long term. As you know, I prefer the simplicity and the flexibility of owning well-diversified global stock ETFs over owning an apartment or house, which I certainly wouldn't consider a passive investment. But that's just my personal preference. Speaking of ETFs, you can find my favorite low-cost brokers in Europe linked down below in the description, which is a great way to support me if you'd like to. Also, feel free to gently tap that like button if you're enjoying the video so far and to subscribe if you haven't yet. Okay, now let's get to the main question we're trying to answer. Is it a good idea to invest at an all-time high, or is it better to wait for lower prices? As we just discussed, there are many reasons why the stock market goes up over time. As a result, it's actually normal for a well-diversified global ETF to be at or near all-time highs quite often. The red dots in these two graphs represent all-time highs in the MSCI World from 1970 to 2021 above, and the US stock market from 1870 to 2021 below. According to research by Dimensional Fund Advisors titled All-Time High Anxiety, since stocks have a positive expected return, it's completely normal for them to reach record highs frequently. Thus, as investors, we shouldn't be worried or excited when seeing all-time high prices. To further prove this point, the American S&P 500 index for which we have the most data, reached a new high in more than 30% of the months over a 94-year period ending in 2020. But wait, the most interesting aspect of the research is still coming. Here are the average annualized returns for the S&P 500 after both all-time highs and a 20% market decline. We can see that historically, yearly returns were actually better in the 1 to 5 year periods following new highs compared to a 20% market decline. Well, I did not expect that. How about you? You actually had better odds of higher returns after an all-time high compared to a 20% correction. Maybe this example can give you a bit of peace of mind whenever you're considering whether or not to invest at all-time highs. At least based on history, you have no reason to be concerned. By the way, I just want to clarify that in today's video, I'm of course only talking about investment into low-cost ETFs, like my personal favorite, the FTSE All World, the MSCI All Country World Index, the MSCI World, or even the S&P 500 in case you only want to invest in the US stock market. ETFs focusing on specific sectors or trends like AI are of course a different story and carry a lot more risk. Now, since I like to include my personal experience in these videos, I spend a bit of time looking back at when my wife and I bought our ETF shares since 2017 to find out how often we were buying at or near all-time high prices. Just so you're not confused, back then we actually started with an Xtrackers MSCI World ETF before making the switch to only buying the Vanguard FTSE All World, first in the distributing and then the accumulating version to optimize our taxes. We've held on to the old shares since they were up significantly and there's an overlap of about 90% with the FTSE All World, so it's still in line with our long-term investment strategy. Alright, now let's take a look at when we invested. I marked the points in time when we invested into the MSCI World ETF with red dots on the chart. Most of our purchases ending in October 2018 were at an all-time high at the time. Meanwhile, we bought the Vanguard FTSE All World for the first time in April 2018 and fully switched over to it as a simple all-in-one ETF investment strategy in August 2019. Once again, the red dots show you all the instances where we bought more shares. And now, when looking at the green arrows, you can clearly see how often we were buying at or near all-time high prices since then. As you probably noticed, we were investing at record high prices quite frequently over our 6.5-year ETF investment career so far. Had we listened to all the news headlines since then, we'd still be standing on the sidelines, waiting for the right time to get in, and our investments will be worth significantly less today. When looking back, I'm really glad we didn't let that influence us. As a result, our portfolio has grown considerably since we started, by over 39,200 euros coming from capital gains and paid out dividends. Obviously, investing both through the COVID crash and 2022's 13% correction, which was the worst year our investments have ever been through, by the way, has not been a smooth, easy ride, as you can see in our monthly and yearly returns here. And yet, we've been rewarded with average yearly returns of 9.87% and an internal rate of return of 8.41% per year so far on our money, which is actually above my long-term expectation of 7% per year when investing in ETFs, with lots of ups and downs in between. One major lesson that I learned throughout this period is that it never feels like the perfect time to invest. There's always something to worry about. First it was Trump's presidency, then COVID, lockdowns, war in Ukraine, inflation, recession fears, interest rate hikes. Basically, it never ends. And yet, now my wife and I are so grateful that we stuck to our simple long-term strategy and let none of that stuff influence our investment decisions. Since the stock market is volatile and regular corrections or even crashes are part of the journey, you should have a time horizon of at least 5 years, ideally 10 years or more anyway when investing into ETFs. So whether that's a lump sum investment all at once or cost averaging into the market at regular intervals, by the way, I'm planning a video on this exact topic, just get started on your ETF investment journey and don't put it off until you think it's the perfect time. There is no such thing. And as you found out today, all-time highs are certainly not a reason to put off investing either. But now I want to hear from you guys. Do you still buy stocks or ETFs when they're at record highs, or do you wait for lower prices first? Leave a comment below and be honest. Also, don't forget to gently tap that like button if you enjoyed the video and to subscribe if you haven't yet. If you'd like to support me, you can use my links in the description below to the best low-cost brokers in Europe for ETFs. Thank you guys so much for watching, have a wonderful week, and until next time.